In this video, I'm going to talk about the 5 retirement accounts that everyone needs to achieve financial independence and early retirement, FIRE, whatever you want to call it. We're going to list them from least important for financial independence to most important for financial independence. Hello, welcome back to my channel. In case you're new here, my name's Ian, and on this channel we talk about finances, investing, and making money. Before we get too far, please remember that I'm not a CPA or a financial advisor or anything like that. So please just do your own research and let's get going. So the first account I'm going to talk about today is the employer-sponsored retirement account. Typically, it's called a 401k. Some other times it's called a 457b plan. But for this, I'm going to just call it a 401k plan. So here are the main reasons that a 401k plan isn't ideal for early retirement. It's definitely important for retirement, general retirement at age 65, but it's not going to be that useful in early retirement. So let's just go through a few reasons here. So the first reason a 401k is not good for early retirement is that you cannot withdraw the funds in the account without an early withdrawal penalty. You can, however, withdraw funds from this account if you have an economic hardship before retirement age, but I imagine that if you're trying to achieve financial independence, you're not going to have too many economic hardships. So for the vast majority of cases, this money is going to be off limits before you reach actual official retirement age. You can get around this with something called a Roth IRA conversion, but that's a topic for another video. Another thing about 401ks is that you usually don't have that many investment options to choose from. You're usually limited to a few index funds and some bonds. They limit your fund options because the employer wants to limit their liability. I guess if they don't let you pick risky funds, then the employer takes on less liability or something. Since 401k money is contributed to the account on a pre-tax basis, you will eventually have to pay taxes for this money in the future. It's basically deferred income. So you're not paying taxes on the income now because you're not actually taking the income, you're saving it for the future. So you do get a tax benefit right now, but eventually you will have to pay taxes for it in the future. And this usually makes sense for most people because they're contributing a lot to a 401k in their high income earning years. And then when they're retired, or if they're retired early, their income's usually a bit lower. So it does help spread out your tax liability and reduces your overall tax burden across the course of your life. So now let's look at why a 401k plan is a good option for early retirement, helpful for early retirement. So the first thing is that 401k plans are the employer usually makes some kind of matching contribution to your account. So sometimes it's 4, 5, 6, maybe 10%. So the employer will match up to a certain amount of your income that you contribute, and they might match only a portion of it, maybe 75 or 50%. So free money is always good. You always want to take this match, obviously. Another thing about a 401k plan is that it can be rolled into a traditional IRA, and you can do this when you're at your current employer, or you can do it after you leave. I always tell people to roll their 401k into an IRA once they leave an employer. That way you just have control of the money and it's all in one account. So every time you leave an employer, you just make sure you take that 401k money and put it in your account, your custody account. So you have control over all the 401k money you earned, and it's all in this one traditional IRA account that you have control over. A lot of people will forget about their 401ks when they leave a company, and they won't remember until 20 years down the road, and they'll forget to log in, and then they'll have to call up their old employer, and it's just a big hassle. So I always make sure you roll that 401k over into a traditional IRA. That way it's all kept nice and neatly under your control. And when you do roll it over into an IRA, you also have a lot more options to choose from in terms of investment vehicles and assets to choose from. A lot more index funds, you can put it in stocks, whatever. That's why I rolled my 401k into a traditional IRA at M1 Finance. M1 Finance is a fee-free brokerage, and they manage IRAs and Roth IRAs and all that as well. And they let you choose from a vast selection of funds and stocks, pretty much anything you can imagine, and you can allocate your money into specific pies, and that's M1 Finance is a really great service. I highly recommend you check it out. Link in the description. If you sign up using my link, you do get some kind of, I think you get $30 after you put in $1,000 into your M1 Finance account. So that's a little bit of free money. As I mentioned earlier, there is a tax advantage to using 401k. You're getting a tax break now in exchange for paying taxes on the money in the future. So that's a good thing about the 401k. Depending on how you look at it, it might be a bad thing if you think taxes are going to go up a lot in the future. But generally, I'm happy to take a tax break now. 401ks also have some of the highest contribution limits of any type of retirement account. The contribution limit for 2021 is $19,500 for if you're single. If you're married, I'm guessing it's about double that. So very high contribution limits. I don't max out my 401k, I just take the max. Pretty much all the other accounts I'm going to talk about today, I max those out as much as I can. One last thing about the 401k, I mentioned this earlier. You can, when you roll a 401k over into a traditional IRA, at some point you can actually access that money in early retirement if you do a backdoor Roth IRA, and that's basically where you take money from your traditional IRA and transfer it to a Roth IRA, and you pay taxes on that amount, but it gets into that Roth IRA bucket, and you can actually access that 5 years down the road. So that's a Roth IRA conversion ladder or backdoor Roth IRA. I think they're similar, but slightly different strategies. But that is one way you can access 401k money in the future. It just requires a bit of patience because it takes 5 years to kind of for the funds to season. I think that's what it's called. You let the traditional IRA funds season in the Roth, and after that it counts as a contribution to the Roth, and then you can actually withdraw it from your Roth. So that's a cool way to actually access your 401k money down the road. Obviously you can't withdraw it directly from the 401k unless you want to incur some kind of penalties. So in conclusion, the 401k is not the most important account for early retirement, but generally it is very important for traditional retirement. So it's important for the big picture. Also, just a reminder, I rolled my 401k into a traditional IRA at M1 Finance. I've been very happy with the service. M1 Finance, as you know, is the fee-free brokerage. It's got a desktop app, it's got a phone app, and they let you control your money very precisely. Link in the description, check it out. Another service that you can also use to manage your traditional IRA or Roth IRA or brokerage account, whatever, is Wealthfront. Wealthfront is a robo-advisor, so it's a little bit more hands-off, but they do an amazing job managing portfolios and tuning the profiles to your risk tolerance. Both of these services have links down in my description. It's really easy to roll things over and set it up on Wealthfront or M1 Finance. It takes about 5 minutes, so go check those out if you have 401ks that you have to roll over. The next account we're going to look at today is the health savings account, otherwise known as the HSA account. When you contribute money to an HSA account, it is pre-tax money, and when you spend that money on qualified medical or health expenses, which is a surprising amount of, a lot of things are qualified as health expenses. So if you spend your money on these health expenses, you don't pay any taxes on the money at that point either. So it grows tax-free, you make tax-free contributions, and then when you take it out, you don't have to pay any taxes on it either. So this is like the triple tax savings account, as some people call it. Problems with the HSA account are that you can only make very small contributions. This year you can only contribute $3,600 per year this year. It goes up next year. That's if you're single. If you're married, it's $7,200. So that's the only problem with the HSA is the low contribution limits. However, let's look at the bright side. This money is never taxed when you use it for medical or health expenses. And you can also use this account as a savings account. It's in the name, but if you just keep track of your medical expenses and document them, and instead of reimbursing yourself, you just save the money, you can actually save that money and let it grow and then withdraw it in the future when you claim your expenses. And you can do this at any time in the future. It doesn't have to be the year you incur expenses. So this is a great way to save for the future, and the money you withdraw from the account will be tax-free as long as there's an associated medical expense with the dollar value you withdraw. In short, make sure to start maxing out this account as soon as you can in your career. So similar to the 401k, I always make sure to roll my HSA account over from the employer-sponsored plan to a personal HSA account that I keep all my HSA funds in. I rolled my previous employer's HSA into an HSA with livelime.com. They have a really great HSA service. It's fee-free, and like most HSAs, you can invest a portion of your funds in the stock market. So they have a connection with TD Ameritrade, so you can set it up where some of your funds are in your TD Ameritrade account as an HSA investment account. So Lively has been a really great account for me. Check it out in the link below. Also, if you want to see how Lively works, I have a card up here for a video I did about Lively. I'll kind of walk through it all, so check that out if you're interested. The next account we're going to look at is the taxable brokerage account. So the main and only downside of a taxable brokerage account is that you have to fund it with post-tax dollars, so money that's already been taxed. That money grows, and when you withdraw it, you have to pay capital gains taxes on the earnings. So ideally, it's long-term capital gains, which is taxed at a lower rate. Short-term capital gains are going to be taxed at your ordinary income rate. So you want to make sure you're in it for the long run. That's really the only downside of taxable brokerage accounts, just the extra taxes. It's in the name, taxable brokerage account. The pros of a taxable brokerage account, there's one main feature. There's no contribution limits. So that means you can pile as much money in a taxable brokerage account as you want. And there's also a wide variety of services that offer taxable brokerage accounts. Pretty much all your Robinhood account, my public account, TD Ameritrade, E-Trade, all these services are pretty much working on taxable brokerage accounts. So you have a wide variety of options here to choose from. So I use Wealthfront to manage a few taxable brokerage accounts. Wealthfront is a robo-advisor. So everything's pretty automatic, it's pretty hands-off. So every month I just put some money in each bucket and allocates it appropriately between stocks, bonds, dividend stocks, all that stuff. There's a link down in the description if you want to sign up for Wealthfront. Using my link, you get $5,000 managed for free. I think that's on top of what Wealthfront already gives you, so that'd be $10,000 managed for free. So that would basically make Wealthfront a free brokerage for a few or several years. After that, they charge a 0.25% management fee on the money above that. So it's still a very competitive fee, and the amount of sophistication and automation that goes into the Wealthfront software is definitely worth the advisor fee. So the next most important account for early retirement, by the way, we're number 2 on we're down to the last 2 here. So this account is the second most important account. So this is the Roth IRA. The Roth IRA it's similar to a traditional IRA, except the tax burden is flipped. You have to pay taxes up front. So you fund a Roth IRA with post-tax money, after-tax money, whereas with a traditional IRA, you'd fund it with pre-tax money. And with the Roth, you don't have to pay any taxes on any of the money or earnings at any point after that. It's tax-free after that. So with a Roth IRA, you can contribute up to $6,000 a year, which unfortunately is kind of low compared to the 401k or the IRA, but it's still substantial. However, this can be effectively bypassed with the Roth IRA conversion ladder or backdoor Roth IRA, which again is a topic of another video. Actually, if you want to learn more about the Roth IRA conversion ladder, there's a link in the description that this video explains it very well. I would highly recommend, if you're curious about the Roth IRA conversion ladder, go check this video out. It's a video that's not on YouTube. I don't know why, it's on a different service, but this video is really informative. I highly advise you to check it out. Another problem with the Roth IRA, besides its pretty low contribution limits, $6,000 if you're single, and I think it's $12,000 if you're married. Once you reach a certain income, basically you can no longer contribute to a Roth IRA anymore. I think it's around $130,000, but once you pass that income, your contribution limits to a Roth IRA slow down to I think 0 once you hit 130,000 about. And then another problem with the Roth IRA is that you're not getting an upfront tax break. Even though you are getting a tax break when you take the money out at the end, you do not get a tax break at the beginning. So that's why it's really important to start maxing out your Roth IRA as soon as you start making income. So, always take your 401k, employer match, but once you hit that, start contributing to a Roth as soon as you can, because you want to make sure you can fund as much of that Roth as you can before you could get phased out based on income. But also, once you reach higher and higher incomes, the Roth becomes less appealing because you have that upfront tax hit. So it's really important to take advantage of the Roth when you're in lower income brackets, earlier in your career, or even in high school or college. So here's why the Roth is good for early retirement. Obviously, you have your upfront tax hit, but you have, when you take withdrawals, tax-free withdrawals, nothing to worry about. The government cannot touch that money anymore. Another very important feature of the Roth IRA is that you can withdraw the principal, the money that you've contributed, at any time. Whereas earnings, you have to wait till retirement age. You can withdraw the principal at any time. So if you can kind of use the Roth IRA as an emergency fund or kind of a long-term savings fund. And if you fund it well enough, you can even use those contributions to support you during early retirement. Also, a Roth IRA is an individual account. It's not through an employer or anything. So there's a wide variety of services you can use. I use M1 Finance, as I mentioned earlier. You can also use Wealthfront. Also, if you want to invest in real estate through a Roth IRA, you can set one up through f.i.r.e, which is a real estate investing platform. If you're interested in f.i.r.e, check out the link in the description. I have a regular account with them, and it's a pretty cool feature, but a very small part of my portfolio. So basically, the Roth IRA is the second most important account for early retirement because you can take early withdrawals on the principal. And then you can also do your backdoor Roth IRA conversion. So you can take your 401k money and shuttle it into your Roth IRA. That's why the Roth IRA, in my mind, is one of the fundamental building blocks of an early retirement portfolio. So the fifth and most important account for financial independence / early retirement is the real estate account, which sounds kind of weird, but here's the thing. Every property that you own is kind of like a bank account. First of all, you earn income on the property when you rent it out. But you can also tap into the value of the property with a home equity line of credit or a cash out refinance. So not only does real estate provide pretty good income that grows every year, you can also tap into the value pretty easily. So let's get the problems with real estate out of the way first. When you have real estate, you have to deal with tenants and toilets. You have to deal with repairs and renovations. There's just no way to get around that too easily unless you hire a property management company. But then again, they can only do so much. Another thing is that real estate is just not as liquid as stocks or bonds. It's a process to sell real estate, and it's a process to buy real estate too. And finally, there's a pretty high barrier to entry with real estate. You can't just go set up an account with $100 and contribute $50 a month. You have to be prepared to spend $10,000, $15,000, $20,000 on your first real estate purchase. So this leads me to my first point about why real estate is the best vehicle for retirement. Real estate has a relatively low upfront cost. That $10,000, $15,000, $20,000 might be a lot, but compared to the actual value of the asset you're buying, it's a very small amount. You're 5, 10, 15, 20%. So you can do that because you can leverage it to a very great degree. And I know houses aren't cheap, but $10,000 going towards a down payment is going to go a lot farther than just putting $10,000 in a retirement account because you're leveraging. And then the next point is that real estate gives you a very steady stream of cash flow throughout early retirement and so on to your kids even. That is when you rent out real estate. You have to actually find tenants and rent it out. So make sure you do that. And then also depreciation of your properties during early retirement lowers your tax bill, helping you reduce taxes from all of your income sources. So if you're getting income from your brokerage account, or you have a side job, or some other forms of income, depreciation will help offset that income, even though you're not actually losing money. And then also, you don't even have to pay taxes on your real estate when you go to sell, as long as you do 1031 exchanges. So as long as you're upgrading your properties, if you decide, I don't want this rental property anymore, you sell it and then buy another one, maybe one that's slightly bigger, or maybe even a duplex or a triplex, you don't have to pay taxes on that sale because you're doing a 1031 exchange. So there is a way to never pay taxes on real estate with the 1031 exchange. And then eventually in 30 years, when all the mortgages are paid off, you will have a lot more cash flow coming straight into your pocket because you don't have to make that mortgage payment anymore. So there we go. We got the 5 accounts that everybody needs for early retirement and financial independence. We got our 401k, which should always be rolled into a traditional IRA at some point. Then we have our HSA, health savings account. Then we have our taxable brokerage account, and then we have our Roth IRA, and then finally, we have our real estate account. Let me know if you have any thoughts on this, or maybe you thought one of the accounts was more important than the other based on how I ranked it. Let me know if you have any disagreements. I've been thinking about this for a while. What are the most important early retirement accounts? And I came up with this list. I tried to rank them, and if you have any disagreements on how I rank these, please let me know. I'd love to hear your opinion, because I'm sure there might be some good reasons that you might want to reorganize some of these. Maybe your 401k is more important to you because you get a much higher company match. Let me know. As always, thank you very much for watching. Hit the subscribe button if you haven't already. If you liked the video, hit the thumbs up button. If you didn't like it, you can always press the thumbs down. I don't care. Whichever one you do, it helps the channel out. So thank you very much for watching, and I'll see you next time.